Most people think selling options is free money until it nukes your entire portfolio. You probably heard selling options is safe. Well, until it isn't. And I'm going to show you how I'm able to manage and avoid that trap at all costs. So let's jump right into it. So naked selling is tempting. Why is it tempting? Well, because of high premiums, high probability of profit, amazing win rates, and you don't have to predict direction. This makes it very appealing for everyone, from a high advanced level trader to a beginner guy trying to make passive income. All of them see potential and they see utility in selling options. But here is the catch. The problem with this is unlimited risk. Let me show you what I mean. Look at this. Right now, we are here on Bitopics. You're looking at puts that I'm trying to sell. And here we're going to take an example with 0 DTE options, but it can be with weeklies, dailies, monthlies, even leaps. Of course, selling leaps is a little bit weird, but you do get the point. So if we go right here and look, for example, at the 2300, we have $4.22 in price for a single contract. Now, Ethereum is at 2416, so we're more than $100 away from this strike. Well, you could say, this is easy money. I'm gonna make $4 and I need a margin of $250 for me to make $4. There's way more than 1%. That's actually 1.68%. If you do that daily, you're gonna be able to reach almost 1,000% per year. So this is huge returns, right? Well, you could say that until you get screwed. Well, Everton, why is that? Take a look, for example, in the past days or so. We go to Ethereum, we go to the 4 hours, for example, and look at this. Ethereum was the same price that it is right now just a few days ago. And then it went in a matter of 4 hours. Let's actually do 8 hours. It went all the way to $2,200. So imagine you looking at this, you think to yourself, well, we already are in oversold right here. We're not going to drop more. I think we're safe. I'm going to sell a put right here. And this is it. Guess what? You're going to be in huge trouble, especially if you are on 0DT options. Why? Because you see huge returns, but naked options are scary. And I'm telling you this because I lived through this. I've lived through the pain of losing a lot of money, even when having over 90% win rate. So it means that I was winning 9 out of 10 times, making consistent income out of this. But then that 10%, that one time that I lose, is gonna wipe back most of the profit that I had made in the 9 times. Why? Because it is a huge risk. It is actually unlimited risk if you sell a call, and destructive risk if you sell a put, because a put has a limit of 0. The asset can go all the way to 0. But guess what? A call has a limit of infinite. The asset can go to $1 trillion. Of course, that is implausible, but not impossible. It just has low odds of that actually happening, but the sky is the limit for calls. So that brings huge risks for you that are selling naked options. So if in this case, Ethereum flash crashed from 2400 all the way to 2200, you could either lose your whole amount or you could get liquidated, and getting liquidated sucks. And yes, with options, you do have possibilities when you can get liquidated. Well, Everton, but I thought options were better than futures because they were not liquidatable. You cannot get liquidated. Well, this is true on normal circumstances. When it comes to huge movement shifts in price, it could cause liquidation because we are still crypto. We lack liquidity in these things, and protocols and platforms have to close that to avoid risking more money for the user and for the protocol itself. So there are liquidations in some occasions for options too. We have real world cases of people losing money like this. For example, with FTX, with Luna crash, with Ethereum crash, with these flash crashes that we see, the black swan events that we called multiple times here, where Ethereum moved 10, 12% in just a single leg in 1 hour, in minutes. It wiped people, liquidated a bunch of people, and then went back up. You could have been one of these guys losing, and you're gonna lose a lot of money. Sometimes you can lose your whole margin. So imagine you get to a point like me, for example, when I'm putting $10,000, $15,000 in margin. Well, these liquidations could trigger the full margin to be wiped out. And I can tell you, they will be tragic. Imagine working years of your life, getting that money ready, making income, actually tangible income out of this, passive income out of this, and then out of the blue, one day it is gone. Well, why is that? Because you were too greedy. You could have said, well, but I was being safe because I sold 5%, 8% far out of the money. So it was super safe, but still you were not intelligent enough or smart enough to do something about it. And what would be the solution, Everton? You're just telling me that I'm bad, telling me that I suck. What would be the right way? Well, the right way would be selling spreads. So vertical spreads are going to solve your issue because you sold, for example, the 2200 put. Now, what you're going to do, you're going to buy back a leg below that. So you buy a 2100 or you buy a 2150 or you buy a 2050. Well, you buy something below that. Why? Because that is going to protect you from losing more money if the time comes. So when you open a vertical spread, the maximum risk you're going to be running is the spread. So the difference between what you sold and what you bought. Let's say the 2200 minus the 2100, that gives $100 of spread. Now you're going to multiply that by the contract size. So if you're selling one option, you're going to multiply that by 1, and by 2, by 3, by 4, according to the contracts that you are multiplying that by. And then you're going to subtract the premium that you are collecting. So in this case, we will be making, like, I think it was $5 from the put that we were selling, and then we paid $3 to buyback, so $2 in profit. We're going to be subtracting the $2 to the 100, which is the spread. That gives us around $98 in maximum loss. Guess what? Remember, you put $250 in margin. So out of your whole margin, you're going to lose maximum just $98. Of course, it is still a high loss, but because we have high win rate, remember, this still works with the same principles as just selling a naked put. We now are just protected. It gives us shorter ROI, but throughout a span of multiple trades, multiple losses across both of them, these spreads are going to be more profitable because when we lose less. So the times that it takes to recover from that loss is way faster than the times that it is to recover from selling a naked option with no protection at all. So of course, it doesn't mean that it's going to be so bad for you, because yes, you're going to be lowering your ROI, but still, you're still going to be able to make very good income that other people around you are not going to be able to do. For example, here on Bitopics, the copy trading strategy has made 90% over the year. 90% on your dollar. That is an absurd number to think of. So imagine if you can do that just like the copy trading, and you get, for example, a 0.3, maybe 0.4 every single day. That is an astounding return over the year. So small wins, consistent wins, and small losses, which makes the wins even more profitable because it's going to take less time to recover from them. So this is how you survive long enough to start that compounding effect. So hopefully this was insightful to you. If this video saved you from blowing your account up like I did multiple times, comment down below spreads, and I'll make you a video showing you how I choose my own spreads like I did before, but we can get more deep into it. So comment down spreads if that has saved you from making a huge mistake and risking your whole portfolio. Thank you so much for watching. I'll catch you guys in the next one. Take care.